there. I wanted to make a video that's straight learning today. What we're going to learn is how to use a particular candlestick. Okay, candlesticks are very powerful, and they are out of our Eastern toolbox of the tools that we use. There's an Eastern and then there's a Western toolbox. Okay, so we're going to be using the Japanese candlesticks to do that. Now the candlestick that we're going to learn today is called the hammer. The hammer is one of the most powerful candlesticks out there. Okay, I'm a pretty big stickler on the exact definition of candlesticks and their applicability, because otherwise you see them everywhere. And many times out there in the free Forex training and these free courses that you take, some of them are just plain flat out wrong. Okay, so let's learn the correct usage of a candlestick. And if we're trading candlesticks, just straight off the candlesticks, which are the only predictive tool out there for the markets, then we need to learn how to use those correctly. So we do have a candle, we do have a hammer, and our hammer is right here. Okay, this is our hammer, and it's in this case is the best case scenario. Okay, sorry, I got my little arrow here in the wrong place, but in this case it's the best case scenario. Okay, there's a little hammer with the body being green. Now what's happening with a hammer is the bears are in control. Okay, they drive the price down, and then the bulls regain strength. They drive price back up, and then they close at either higher than the open or they close at lower than the open, but they actually fall. The candlestick formation actually follows what looks like as a hammer. Okay, so graphically during the course of this trade, price is driven down. Okay, and then afterwards the bulls come back in, and in this case drive it up past the open. Okay, with that open being right here. Okay, that's where the open was. So we drove it past higher than the open, which gave us the green candle, and it closed at a higher value, and that higher value was here. Okay, so that is our candlestick called a hammer. Now the definition of a hammer is that we do have, for any candlestick, we have got tails and we've got a body, right? Well, the body needs to be of any size. Okay, and typically what I find to be very good hammers are more of a square block. It doesn't have to be. Now the tail has to be, it absolutely has got to be 2 times the width of the body. Okay, very simple. So here's 1. Okay, it needs to be equal to 2 times the width of the body or greater. Okay, so the body is about, and we just do this by eyesight normally. Okay, so the body is about 1, is about that wide, I should say, and then the tail, if you multiplied it by twice and stacked it down below, it needs to be at least this long. Okay, roughly. Okay, and it exceeds that. So we have a valid hammer. Now, how do you trade a hammer? Nope, actually I need to go into more detail. I can't just get into trading yet. Another characteristic of trading candlesticks is you may see this symbol, okay, this formation at the top of a trend. If it is at the top of a trend, it is not a hammer. Okay, it was only a hammer at the end of a downtrend. Okay, so there has to be a downward move in order for this to apply. Okay, now day traders trade candles straight off the candlestick formations, and sometimes that's all they have on their charts. Okay, so how do traders trade this? What would be a way that you would trade this? There are two schools of thought. Very aggressive traders get in immediately during this candle, even if it was red. During this, it opens here, okay, and then it goes down and it's red. Then it comes back up and it surges way up here. Then it comes back down and it closes. Very aggressive traders will actually trade just immediately on the other one. A more conservative aggressive trader will only trade when the close is going to be higher than the hammer's close, which it was here. Okay, so they would get in on the following candle. Now that's getting in. Okay, what about setting stop losses? What about trading, right? What about those other things? So you would place a stop loss a few pips below the tail, okay, and you would let that be. Okay, now money management rules will tell you that, well, if this is where I place my stop loss, okay, and I get into this trade, well then I could it's possible that I could lose, right? We could be way up here. My stop loss could be 90 pips away, and in this case it was. But in this case, did it work out for you? Yes, it did. Okay. Now, how you manage the trade after it's progressing, that's a completely different topic. Okay. Okay. So that's pretty much it, and let's just look how that played out for you. Okay. I can shorten the scale down a little bit here for you, and we can go back here and get let's just say we got out on another formation that's very clear here. Even at a low, is still 333 pips. Okay, that's pretty darn good. I will take 333 pips any day of the week. Okay, so what you got today was 333 pips of profit taught to you, right? So take that 333 pips, invest $100 into the market using any one of these, and of the many things. The reason why I'm doing this is because I want you to come buy our course. So come out today, buy the Mission Phoenix course, the Forex course, and we're going to teach you how to get through and do all of this. And not only that, we're gonna give you some of our proprietary indicators that help this out, and we're constantly learning about more indicators. There's one that I've just developed, and it is absolutely amazing. It's actually never been easier to get into trades. That's the hardest part, is getting into the trade. It's never been easier with us. So let's come on out, and we'll make some money. All right, have a good day.